Martin, one of the things I think that's been difficult for a lot of people this year is just kind of looking at their overall portfolio and depending on how it has been constructed, looking at perhaps some significant losses if they were 60-40 equities and fixed income, because we've seen pressure in both areas of the market with rates rising significantly. We've seen a lot of downward pressure on the value of their fixed income portfolio. So how do you think investors should be looking at fixed income today?
Well, it looks a lot more attractive than it was 9 months ago.
Yeah.
We follow it very closely in regards to duration exposure, not just on the fixed income, but comparing it to the duration exposure on the equity side. If you ask your advisor or portfolio manager what the duration exposure on your equity portfolio allocation is, they'll just very likely give you a blank look. And so I definitely challenge you to do that. But what it does is it tells you who's more bearish or bullish in regards to the forward outlook and what central banks are doing. And so there are dislocations. And so you could do a 20-year treasury versus the NASDAQ, for example, and there are gaps there. And so there was a period of time the last couple of weeks where the investors in 20-year treasuries were a lot more bearish than what the NASDAQ was. And so if you are looking at making a duration bet, you can look at what's being factored into the valuations on fixed income versus equities, if that makes sense.
I think you're going to have to explain that a little bit more. People don't think of it like that.
Yeah, and so what I mean by that is we want to look at interest rate sensitivity on the positions that you own. And so what we mean by that is the longer the exposure to the term. So if you're 20 or 30-year bonds, the greater sensitivity you're going to have to interest rates. And companies that depend on capital and a low cost of capital that don't have a lot of upfront earnings that were projected to have growth, but earnings down the road are very similar in regards to their exposure to interest rates. And so they will move up and down with interest rates as well, too. So what I mean by that is those types of stocks will say, hey, we think interest rates are going to fall in 2023 and come back down again. And so as a result, we're going to own this and our multiples are going to go up. And if the treasuries, the yields haven't moved, they're saying, nah, we're not thinking that it's going to happen in 2023, maybe 2024. And so if you're looking at buying into that kind of a trade and you think that rates are going to fall in 2023, you're better to do so through the bond market. And so that's where a good portfolio manager will come in and just look at these sorts of things and help determine the proper allocation and where there's better value opportunities.
So, and again, it does go back to what we've been seeing, quite a bit of dislocation in the market. And at the end of the day, again, I think that you have to be able to get the interest rate environment right. And that has been very, very difficult. I mean, I think I know a lot of incredibly successful hedge fund managers that, decided they didn't want to fight the Fed over the past decade or so because you couldn't really go short. Because they were just pumping up the market. So with all the liquidity, so we have all these different dynamics that make money management difficult. But I guess at the end of the day, look at the dislocations and try to figure out again where we might be going. Not easy to do. You can see it in a lot of people's results. Having said all of that, though, what is the view right now then in terms of going long some corporate bonds, as an example?
Yeah, and so I call that the chicken little, or not the chicken little, sorry, a chicken way of playing the equities. So there's a lot of fear out there right now, and investors, from what we're hearing, are looking and saying, well, I'll just buy GICs that pay 5%. But if inflation does stick around, that's still a negative real return, and it will impact your goals. And so if you want to look at going into the market, corporate bonds are really interesting. In Canada, for example, you could buy a basket of these corporate bonds, paying a 5.5% coupon yield, and you get the optionality so that if rates do fall back down again, there's probably about 10 to 12% upside in capital appreciation. So now you're talking about mid-single digits. You get paid while you were waiting for the eventual recovery. And so that's a safer trade, in our opinion, than simply just buying a basic index.
Would you use an ETF for this?
Yeah, so one of the ones there are some good ETFs by BMO or iShares. XCB is
Okay.
one, for example, that we've used. So for the
Okay.
average investor, there's some good ETFs out there.